Hey everyone, I've got some unfortunate news for supermicrocomputer stock investors. Now, let me make this clear. The company had an absolutely excellent third quarter, but it wasn't all great. There was one segment of its quarterly performance that was unfortunate, and that's what I'm going to focus on in this video. Okay. I've broken down the latest quarterly earnings into several segments. And in this one, I'm going to look at its cash flow from operations, how it could impact its growth going forward. Now, remember, it grew over 200%. That's not an easy thing to do for a hardware company. And it's showing up in the cash flow. So let me share with you this. Let me dig a little deeper into this video, into this part of its earnings. But I just wanted to highlight in front that the whole quarter wasn't bad. Just this part of the business is perhaps lagging the rest of the business as it's growing. And that's normal. That's normal for a hardware company that's growing at this rate. These kinds of situations are normal, and I'll explain to you in a little more detail why that's the case. So let's take a look. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, so the unfortunate news was that cash flow from operations for Q3 was negative 1.5 billion compared to negative 595 million in the previous quarter. So this is 2 straight quarters of negative cash flow from operations, and that's over negative 2 billion now in 2 quarters. And if you think about a company's cash flow, there's 3 ways a company can generate cash flow, just like there's 3 ways you can generate cash flow. You can borrow money, you can earn money, or you can sell your assets. Those are 3 ways you can raise cash, right? Of course, the most ideal way is to earn money. That's the most sustainable. You can't borrow money forever, right? That's obvious. You can't sell your assets forever. Eventually, you'll run out of assets to sell. Sell your house, your car, your jewelry, your electronics. You won't have anything left to sell. Okay, but if you earn that, those earnings can potentially last a lifetime. That's where you want to see a company generate its cash flow from. That's why cash flow from operations for a business is the most vital area I look at for cash flow. Now, just like a household, a company can generate cash flow by borrowing money. A company can generate cash flow from sales of assets, okay? And Supermicrocomputer, unfortunately, is generating negative cash flow from its operations. And then to pay for that, it's using financing, borrowing money, issuing more stock in order to finance those losses. So in their third quarter, their inventory jumped to 4.1 billion as of the end of the third quarter, and that was up by 67% from the previous quarter, where they had 2.5 billion of inventory, and this was due to purchases of key components. Now, remember at the top of the video, I said that this is normal for companies growing as quickly as Supermicrocomputer. Remember, they just grew 200% in their latest quarter. That's explosive growth, and they deal with physical products, physical inventory, server racks, etc., right? So they've got to secure that inventory up front before they can go and sell that inventory to their customers. And then once they sell the inventory to the customers, they may not get paid for some time. The arrangements might be 30 days, 60 days, 90 days, or even longer, depending on how eager Supermicrocomputer is to make that sale. And given that Supermicrocomputer is not in the negotiating position of power in these relationships, it's usually dealing with enterprises that are much larger than itself, and it wants to make that sale. Management has said, like, they're focusing on gaining market share, so they're willing to offer friendly terms to secure that sale. And so that's leading to a cash crunch where they're spending money on the inventory, using cash to get the inventory, And then when they're making sales, they're not getting the cash until a little bit later. And then when you're growing and you're expecting to grow 200%, that means you're getting more inventory this quarter than you did in the previous quarter that you're getting cash from your sales months ago, because sales months ago were much lower than your sales in the current quarter. So you're lagging behind your cash flow accumulation because you're always growing. Well, not always, but in Supermicrocomputer's recent quarters, they've been growing by such magnitude that they're needing to get cash. They're needing to use a lot more cash up front, and then it's taking time for them to collect the cash payments from their customers, which is leading to a cash crunch. -2 billion, over -2 billion. Where's that cash going to come from? Where in the latest quarter, they raised $1.5 billion from a 0% coupon 5-year convertible bond offering that's due in 2029. What this means is it acts as a bond and a stock. The person that's lending, that's giving Supermicrocomputer the money, can either ask for the money back as just a cash repayment, or if Supermicrocomputer's stock price reaches really high levels, it can say, no, just give us the amount of stock that we agreed on in this deal. So the lender in this case, the investor, has the option to choose. Do we want to make it a bond or do we want to turn it into stock? If it's whichever one is more favorable, that's the one the lender's going to choose. That's how they raised the money. And then they raised approximately 1.7 billion, another 1.7 billion from the sale of 2 million shares at a price of around $875 per share. So this is just a pure stock sale. This dilutes shareholders. More shares outstanding means net profit will be split among more shares, thereby reducing the earnings per share. Okay? But they needed to get the money somewhere, and this is how they chose to get the money. Now, you could argue that when management chooses to sell stock instead of borrow money to raise capital, they think their share price is overvalued, and so they're using their stock because they could very well have gone out and borrowed money, and that would have come at a lower cost of capital than selling stock. Usually for most companies, unless they're really desperate, in a desperate situation, their cost of debt is lower than the cost of equity. And so if you're issuing more equity, that costs you more. So typically the only reason companies do this is when they feel their shares are overvalued. And so this is what they did to raise the capital and generate more money. Now, the closing balance sheet, they have $2 billion, while the convertible note debt was $1.9 billion. So now they have $2.1 billion in cash. That's okay. But if they proceed at, negative $1.5 billion in cash flow every quarter, they're going to run out of this cash quickly again. So the company's management needs to adjust their cash conversion cycle, either tell their customers that they need to pay them back sooner, or maybe pay them up front, give them a down payment, and then arrange with their suppliers, if they can negotiate, if they have the negotiating power, to say, look, we've already made these sales, or we're going to make these sales. Our customer demand is explosive. We just need time to pay you back. Can we pay you 60 days later or 90 days later instead of paying you up front or paying you in 30 days? So they've got to work on that, both with their suppliers and with their buyers, to bring this in better balance for themselves. Because right now, it's not in a good situation for Supermicrocomputer. It's causing disruption on its balance sheet, on its capital structure. So I'm looking forward to next quarter management getting this under control, not completely eliminating all negative. It's difficult not to be negative in cash flow when you're demonstrating 200% growth quarter over quarter. It's understandable to have a little, but just bring it in line, narrow these negative cash flows and narrow these purchases and outflows, get it into a little bit better balance. And so you don't have this cash crunch going forward. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.